One of the biggest challenges when committing to a private equity fund is what to do with your capital while you're waiting for the manager to call it. In any private equity deal, it can take between 2 to 4 years before your capital is fully invested. In most cases, what we've seen is that investors prefer to put their money in cash. One of the biggest challenges with that is that cash doesn't earn a return. And the alternative is to put your money in liquid securities. Markets tend to go up 80% of the time. So you have a very good likelihood if you invested that in public securities, you would be ahead of the game. Now, certainly in the short run, the markets might go down and you experience some volatility. A lot of people do the same thing. They do what's called bucketing their capital, right? If you have $5 million in investable assets and you commit $1 million to a private equity vehicle, you've bucketed that. You've taken that $1 million out, you've set it aside. The reality is that money is fungible, right? So if you actually commit $1 million to the private equity fund and you keep all of your money, all $5 million of your capital invested in public securities and growing, you're not missing out on the market and you have a very high likelihood of that money growing over time. That is the best and most efficient way to manage your capital. Now, it doesn't come without risk. Certainly the market can go down during those 2 to 4 years. But think about it like this. If you have a healthy ratio of liquid securities to private commitments, it shouldn't matter. This strategy will outperform the alternative of putting your money in cash.